Welcome, Ela. I'm N. Vadivu, Assistant Professor, Department of Commerce. Today we're going to see about the income tax and tax planning, Unit 1. In this Unit 1, we are going to see about the introduction to income tax, residential status, and scope of income tax. First, we'll see about what do you mean by tax. Tax is a mandatory fee or financial charge levied by any government on an individual or an organization to collect revenue for public works, providing the best facilities and infrastructure. The collected fund is then used to fund different public expenditure programs. Who introduced income tax? James Wilson, the first finance minister of the British Indian government, introduced the tax system in India. In 1860, income tax was introduced by James Wilson in India. History of income tax. In India, such tax was first introduced in 1860 by Sir James Wilson to meet government problems due to the 1850s and military mutiny. A new income tax was introduced in 1918 and it was then replaced by the other new act that was passed in 1922. This act was stayed with effect with various changes up to the assessment year 1961 to 62. Finally, the Income Tax Act 1961 was passed in consultation with the Ministry of Law. With 1st April 1962, the Income Tax Act 1961 was brought into the effect. It refers to entire India and to Sikkim, which includes Jammu and Kashmir. Some of the objectives of income tax. The objectives of income tax may be to reduce the inequalities in the distribution of income and wealth, to bring out equity between class of people of taxpayers, to accelerate the economic growth and development of country, to make available of funds for economic development, to encourage investment in new capital goods, to channelize investment into those sectors which contribute the most economic growth. Some of the features of income tax are by the Finance Act of the relevant assessment year. The Finance Act is passed every year by the Parliament in the form of budget. The income tax is levied on a person in relation to his income of the previous year. Residential status in the previous year or accounting year. Liability to income tax arises only where the total income in the accounting year exceeds the maximum tax-free amount. The rates and instance of income tax, it's compulsory to deduct the tax at source and to pay to the government. There are two types of taxes, direct taxes and indirect tax. Direct tax. Direct tax is really a tax which is paid by a person on whom is legally imposed and on the burden on which cannot be shifted to any other person. It is called direct taxes. For example, income tax and wealth tax. This direct tax is calculated on the basis of the five heads, namely income from salary, income from house property, income from profit and gains from the business or profession, and income from capital gain, and income from other sources. Similarly, indirect tax is imposed on all the individuals, all the SSC, yeah, in the form of for availing services or while purchasing a product, for example, service tax, VAT, excise duty, custom duty. This burden can be passed to a third party. This indirect tax can be shifted to any other person. Residential status of an individual. So, in order to be a resident, an SSA have to satisfy one of the basic condition. He has to be in India for the relevant for 182 days during the relevant previous year, or he has to be in India for 60 days, and he has to be in India for at least 365 days during the four preceding relevant previous year, and he has to satisfy both the additional conditions. He has been in a resident in India in at least 2 out of 10 previous year immediately preceding the relevant previous year, and he has to be at least 730 days in during the seven previous 11 preceding 11 previous year. The important point is the day on which he enters in India as well as the day on which he leaves India shall be taken into the account as he has stayed in the India. Who is said to be a not ordinary resident? If an individual satisfies any one of the basic condition and he doesn't satisfy the two additional condition, is said to be a resident but not ordinary resident. And if he doesn't satisfy both the basic condition, he is said to be a non-resident. And next one is the scope of the total income or instance of tax. Income received or deemed to be received in India is taxable for all three cases, that is, ordinary resident, not ordinary resident, and non-resident. Income accrues and arises and deemed to accrue in India is taxable for all three cases. Income accrues or arises outside India, but the business and profession setup inside India, it is taxable for the resident, ordinary resident, and not ordinary resident, and it is not taxable for the non-resident. Income accrues outside India, but the business and professions are set up outside India. It is taxable only for the ordinary resident, and it is not taxable for the not ordinary resident and non-resident. The past foreign income bought in India, it is not taxable for all three cases. Thank you. In the next video, we'll see about the exempted income. Thank you.